Hello and welcome everybody to this XTB Trading Club. My name is Walid Koudmani, Chief Market Analyst for XTB. And thank you very much for being here with us. Today is going to be a very interesting Trading Club webinar where we're going to be talking about the ongoing tensions and obviously the crisis in the Ukraine, how that is impacting the markets, what markets are being impacted the most, and what we can expect moving forward. Of course, as always, for these events, if you have any questions, feel free to ask, because these are partly obviously to answer your questions. So if you have any questions regarding any markets that you might be interested in, feel free to ask, or if anything is not clear. We're going to be going through some slides as always. Going to do a quick audio video check just in case you can hear me. And then, perfect. Thank you for being here with us, Sufyan. I recognize your name as well. You've been with us before, so thank you very much for being here with us. So we're going to be covering a lot of topics today. We're going to be talking about the stock markets, FX, commodities, some fundamental factors, and some technical levels as well that we're at. The situation can change at any point. If you're curious about some of the background of the situation, you can find a video on our YouTube channel that I did a few days ago, just outlining the situation, how it started, what's been going on so far. So we've been keeping you up to date on the ongoing situation, and we're going to try and do that moving forward as well. So as always, as I said, if anything is not clear, feel free to ask. And if you have any questions besides anything we're talking about today, also, I have access to the chat, which is why I'm looking at the right. That is where the chat is. So without further ado, today's Trading Club topic is how will the conflict in Ukraine affect the economy and the markets? So it already has. Some of you may have felt it. Some of you may have not yet. But we're going to be covering that topic mostly. And again, if you have anything that's unclear, whether through the slides or through the markets that you might follow, feel free to ask and we'll try to get through that as well. As always, we do a brief Q&A section, question and answer section towards the end of the webinar. So if you have any questions as well you'd like, we can do that towards the end. Hopefully everything will be clear, but that's what we're here for today. So that's what we're going to be taking advantage of. So let's start with some slides and then we'll see where we get through those. So as always, the disclaimer first. And we're going to be talking about some of the effects that this has been having on the economy. The conflict, as you might imagine, has wide-scale effects across markets because of the ties that Russia has with a lot of the world through, obviously, exports, imports, as well as the financial relations through the banks. So let's talk about that a little bit. So Russia and Ukraine's trade share is moderate, not as much as you might think. For the EU, it's about 5% of exports and slightly higher imports. For the USA, the share of these two countries is ridiculously small, together less than 1%. So the US actually trades a lot more with other countries, European in particular, South America, and Canada. So they have that alliance as well there. So they're not so much reliant on Russia as maybe Europe might be, but as you can see, even the EU is about 5%. So nevertheless, the loss of half of these markets would be a setback for Europe because they're so reliant on very key fundamental factors. And if you want to look at the, as I said, at the background of this conflict and how reliant Europe is in a sense for the energy market, you can take a look at the video I just did a few days ago where it goes into depth about that topic. So let's move forward. As you can see, the exports here are quite notable, and then imports about 44% are other countries. China seems to be on an import side quite relevant for Russia, United States as well, and the UK, actually surprisingly for some people. So the rising prices has been a topic that we've talked about quite extensively through the inflation. We've talked about the central bank policies that are involved with that as well. We've talked about several aspects of how one thing can affect everything else in the economy. So if the price of oil goes up, then maybe the price of consumer goods goes up, and so on and so forth, how that then impacts the life of everyday consumers. And that's what we are going to see exacerbated even more now moving forward. So for the economy, especially in Europe, the biggest threat is the future or the further increase in raw material prices. They have already risen dramatically, and sanctions may exacerbate this effect. This is the main reason why Europe is afraid of Russia cutting off SWIFT, because that would interrupt basically the payment facilities between the two regions. Higher prices mean lower margins for companies, a gradual fall in demand, and a difficult situation for central banks. Central banks were already struggling with the balancing of interest rates and inflation, which has reached record levels, highest level in about 40 years, both in Europe and the US, very much felt by the average consumer. And then they were trying to basically alleviate that with sustained interest rate increases, which would decrease inflation in theory. Now they have this other setback, which is really not their fault in a sense, because, okay, normal inflation may have been a little bit their fault by the extensive monetary policy that they had in the time, But now we're seeing a slight shift in that, where it really isn't their fault, but they have to deal with it in some way. And they can't deal with it too aggressively, because then the stock markets would really suffer because of that as a result. So central banks are in a tough position, but the average consumer is in an even tougher position as always, where the price of oil might not just affect you if you have a car, it might affect you for anything, because you're buying something that costs the cost of transportation is significantly higher, the cost of storage is significantly higher. Now we've seen a lot of sanctions against Russia where they can't even use their ships or use their ports. So that's really going to impact the end result here. And you can see here on the right, the year-to-date change in these prices. 22% for oil and natural gas plus liquid natural gas is 54%. Coal, palladium, platinum. Palladium and platinum, which we've talked about in the previous video, is a huge export for Russia. So they're actually number 1 and number 2 in the world when it comes to those exports. So yes, Europe might want energy independence. We're moving towards a greener energy situation, but batteries are made of these materials as well. So that's still going to be reliant on Russia's exports in some sense. So it's something that shouldn't be overlooked completely, as if we would just exit the oil market and we're free. That's not how it was going to work. Europe will suffer in logistics. That's quite obvious because of the huge border that it shares with Russia. Even before the conflict, the world was facing huge disruptions in supply chains. That's also adding into the prices. These are set to escalate, with Europe the hardest hit. A stagnatory scenario is becoming more realistic, where inflation is so high that it slows down economic development and recovery. So what we saw past the pandemic to begin with was actually a positive situation that end, where mainly US indices saw a V-shaped recovery, where the drop post-pandemic was recovered quite quickly, and then we reached new all-time highs over and over again. That was in part and mostly due really to the extensive monetary policy that the central banks have had, where unprecedented spending, unprecedented low interest rates for a very long time. As that was set to decrease, or the spending was set to decrease, interest rates were set to increase. That was set to have a noticeable impact on stock markets. But now with logistics, with the actual sanctions that are targeting raw materials and the cost of them, where they're going to have to look for alternatives in a certain way, that's going to impact even more the average consumer, which in the end is the person that does move the economy. Because if the average consumer is so overburdened by inflation, where their wages are not keeping up, so let's say £1,000 today bought me a lot less than it did maybe a year ago or 2 years ago, and that's what is happening in the end. We're get to the point where the average consumer can't even afford to buy the same things they used to buy, and with the increase in prices, that's going to lead to a situation where demand decreases. So with a decrease in demand but a forced increase in supply, or in prices on supply end, there's going to be this mismatch between those two. Again, if anything is unclear, feel free to ask a question in the chat. I have access here. That's why I'm looking to the right. And yeah, so we're going to be covering a lot of this, basically how the impact is happening. You can see here, these are some of the prices that we're seeing as well. Obviously, a huge increase past 2021. Stock markets, again, suffering on a wide scale because of this. And one of the key things for the stock markets really is this unprecedented spending that we've seen. On equity markets, we can talk about the biggest correction since the beginning of the pandemic, but at S&P 500 is still not in a bear market in a sense. Moreover, the main reason for declines is not a conflict, but expectations towards the Fed, which we've talked about extensively. Actually, Powell today had another testimony in Congress, yesterday as well. So markets, they've not discounted the central banks. In fact, they're still a key factor for the central bank. And that was one of the key topics that we were covering extensively, moving into these new changes by the central bank. What is happening now is that on top of that, as I mentioned, there's all this other geopolitical factor that is impacting that. So we can see here corrections all across the board. Now, no doubt the Russian index is the one that suffered the most. It hasn't even been trading in the last few days. Stocks have completely crumbled on that end. We have some extensive analysis on those as well if you want to check it out on the news section of the X Station. But you can see here both ETFs and stocks. So this is DE30, which is the DAX, US 500, S&P, NASDAQ, the European indices, the Polish index, everything dropping down. Now, partly by the central banks, partly by the tensions that we've seen. But we're still significantly above the pre-pandemic levels. So that's something that's worth keeping an eye on as well. Wall Street's still overvalued in the sense of price to earnings. We've done extensive analysis on this. However, Russia on the other side, the indicator compares past and expected price earnings and price to sales to the 10-year average. Looking at it this way, the US is still overvalued while Russian equities are very undervalued. However, questions arise. To what extent will the performance of Russian companies deteriorate as a result of sanctions? Well, the immediate answer has been extremely. Is it possible that foreign shareholders will be expropriated as a result of retaliation? That is a possibility. So what we're seeing right now are sanctions on the companies themselves. We can expect potentially some retaliation from Russia's side, where they were going to try and punish Western governments and Western investors. I don't know how effective that's going to be because, I assume somebody wants an end to this at some point. So when that ends, I don't think that would be beneficial, but it might be a possibility that we might see that as well moving forward. So that would mean basically that they are stripped of their ownership of the shares. I don't know how that would work materially for them in the sense of beneficially, but that is a possibility which can scare a lot of investors. Now, a lot of investors, a lot of companies that have exposure on the Russian markets have already suffered extreme losses. We've seen a lot of companies exit their shares to begin with. So that is a possibility as well moving forward. What does the sentiment indicator tell us? Sentiment after Thursday's session, so last Thursday, was the weakest in a long time. Smaller corrections often ended at this level. However, larger corrections historically led to the indicator of -3. And we can see that here heading down consistently. So quite stable through 2021, where that recovery was starting to take place. Yeah, we had a few more rounds of the pandemic, but at the same time, central banks were set to increase interest rates. The Bank of England already did twice. Federal Reserve and European central banks still haven't, but that's besides the point because that was what they were planning to do this year. So it's expected about 5 or 6 increases this year by the Federal Reserve. Generally, the central bank from Europe follows the Federal Reserve, maybe lags behind it a little bit. Yes. So actually, excellent question. Serge, sorry if I'm saying your name wrong, asks also, interesting that Italian index is undervalued that much. Correlation with Russian assets? Yes, there is actually quite a significant correlation between the Russian market and the Italian market. There's a lot of imports, exports between the companies. Italy was actually one of the countries, along with Germany, and I can't remember which one. There was a third country that was trying to basically negotiate a lower level of sanctions from the European Union because they were so reliant on so many of their goods. So we're seeing an undervalued situation where definitely the US indices are the ones that have been the most overvalued because of the spending that we've seen and the price to earning ratio. And we've done analysis on this in the past where the performance of the actual stocks in the index is not reflective necessarily of the index's performance, because in the US, especially like the NASDAQ, is extremely carried by the FANG companies. So Facebook, Amazon, Netflix, Tesla, Google. They are the ones that have the most weight in the index, and they're the ones, the tech companies that perform the best, so they can drag the index, even if maybe the 80% of the companies are not doing that well. In Europe, the situation is slightly different, where a lot of the companies are related to manufacturing. A lot of them are related to actual economic, let's say, production. So they took a longer time to recover, and we've seen that if you compare the charts, especially after the pandemic, you'll see that basically the US indices are doing a V shape. The European indices are doing more of an upward trend that's more stable. But yes, there is a correlation between the Italian index, the MIB, and the Russian index as well. Of course, the Russian index is the one that has been hit with the sanctions, so that's going to be the one that has the most effects on it. But other markets across Europe are definitely tied into that as well. UniCredit, other banks as well in Europe have been affected because they have a tie. I think we're going to cover that in a little bit, but they also have a tie into the markets as well. Hopefully that answers your question. Moderate slide in the US. Indicators such as the price GDP deviation from the 2-year average or the decline from the last 2-year peak are not at levels that in the past often well signaled an important turning point, which does not mean that the correction is not complete, but only that there was no correction that, based on the historical data, was convenient to significantly increase the exposure. So that's what is happening at the moment. We've seen corrections in the past, of course, and sometimes they're triggered by massive events, macroeconomic things. Sometimes they're triggered just by technical levels, sometimes mixed with those things. So if we go and look at the charts, we can see that sometimes a correction can happen 3 times in a row. Each time is about 30%. And then past that, we see a resumption of the trend. So Cesny asks, when you say Europe, we're talking about the UK markets as well. I'm actually talking about mainland Europe, but we can include the UK as well. I think the UK has even more exposure than a lot of or than some European markets, as I showed you at the beginning in one of those slides. I can go back to that in a second. You can see here imports, exports from Russia towards, you can see here, United Kingdom is here. So about 10% and 14% of exports are to the UK. So it actually is a significant part of the European or the Russian trade. But when I say Europe, I mean the European Union in a sense, mainland, so the continent. UK, I would refer to as the UK. I like to separate them a little bit because the UK is so reliant on the financial sector as well, which really mainland Europe is not. But they do apply a similar, obviously similar ties. Europe mainland is much more reliant on the, so the European Union is much more reliant on the energy market of Russia than the UK, for example. Will the Fed ease policy? So tomorrow we have another data point, which is obviously key for the markets, the NFP report from the US. That's the non-farm payroll report, which shows the change in employment 1 month to the next. Hugely important for markets, for investors, because it gives you an idea of how the economy is performing. Also gives you an idea of potentially what the central bank, how they might look at it. And traditionally the Fed, expectations that the Fed will significantly ease the tightening path in response to the conflict are unfounded for now. So as I said at the beginning, the Fed and central banks have had their policy set now that they want to increase interest rates. This conflict is not their fault. So them trying to, let's say, delay that wouldn't necessarily have the impact that they would want in a sense, because the impact that it would have would mainly be on stocks. But the issue is that there are actually concrete supply and demand or supply issues and sanctions that are limiting supply. So their central bank policy would not necessarily help in that sense because, okay, there's more money in the economy. That just allows prices to be paid that are higher. So in the end, the inflation keeps increasing. That obviously might change. They might assume that, if we do change the policy at a certain point, that might help. But for the time being, that's not really priced in. Market expectations in this matter, looking at the rate market, have decreased slightly, and statements of Fed representatives confirm that there will not be a big change. Let's remember the conflict is pro-inflationary. Obviously, that rises or increases prices further, which then would have to, as we've seen, a higher or lower interest rate is also helping with that. Russian banks with limited exposure outside Russia. The West does not want Russian banks to be disconnected from the SWIFT system, which would be the most severe of the sanctions. So we've seen already some of them be disconnected. However, other sanctions may be ineffective as Russia's largest generate only a fraction of revenues outside Russia, a share that has been steadily declining since the annexation of Crimea. That was in 2014. The weakening of the ruble in response to the annexation of Crimea led to a small financial crisis in Russia, which encouraged Moscow to increase the state's share in the banking sector. So what we saw at the beginning of the week actually was a sudden increase of interest rate in Russia from about 9.5%, 10% to 20% overnight. Closure of the stock market, huge panic because the ruble decreased. So there was the freezing of the assets on the sense of the foreign exchange in the central bank in Russia. Unprecedented, really, sanctions that we've seen. I'm sure some of you have seen the crowds of people in Russia rushing to ATMs to withdraw their money. Their money is losing value basically every day. We've seen a surge in crypto over the last couple of days, and partly it has been due to demand increasing in those countries. So Russia, particularly as a cover against the inflation that we've seen and the currency drop, and also in Ukraine because they were raising some money through cryptos. So Bitcoin, Ethereum were the main ones, and sometimes they tend to carry the rest of them as well. Average revenue from outside Russia for VTB Bank, Russia 2007-2016, 10.8%. The share of revenue from outside Russia has been falling since 2013. EU branches are Italy, UK, and Germany, as I mentioned. Foreign capital accounted for 41.4% at the end of 2020. Sberbank, which has seen a huge loss in their share price. Basically, the bank is crumbling at that point, which is the biggest bank in Russia. 96.5% of revenues are generated in Russia. Branches in the EU have Austria, Bosnia, Herzegovina, Croatia, Czech Republic, Germany, Hungary, Serbia, Slovenia. Foreign capital about 43% at the end of 2020. So there are some exposure, but as you would see with a European, traditional European or UK bank, there's much more exposure across Europe than this. talking about currencies, we've seen a significant decline in the ruble, some increase in the dollar, which is seen sometimes as a store of value in the sense of safe haven. Expectations for hikes in the US have stabilized, but in the Eurozone, they are falling. The economic impact on Europe will be much greater than Russia's greater importance in trade, Russia's greater importance in trade and being a net energy importer. Europe is, and I mean mainland Europe. Logistical disruptions will also be greater. This could prompt the ECB to continue printing. Already, the rate market is pointing to a possible continuation of the downward trend of Euro USD. So, as inflation increases, that is devaluing in essence the currency itself. As we've seen, the Fed still set to do their path of increasing rates, which is supposed to stabilize the US dollar. Europe now, on the other hand, is much more susceptible to whatever is happening at the moment in that context of the conflict. So we could see a different response for the European Central Bank. And we can see here the spread between the Euro USD and the Euro USD 9 to 12. And we see here the same thing, Euro USD on this end, moving towards 0.1, sorry. Attention to SWIFT. SWIFT has been a key topic. We mentioned it last week in a video I did where potential, and even before the conflict started, we mentioned a couple of scenarios where what could happen and what could take place. This was one of the ones that was really not taken into consideration that much, as it was seen as one of the most effective and probably one of the most severe sanctions that Russia could face, effectively really removing them from the global financial system, where they have trouble at that point transacting with any sort of Western government. Now, we've seen some banks actually be subject to that sanction. We've also seen them shift towards the Chinese version of that, which is a CIPS. Now, obviously, the CIPS, the Chinese one, is much less used. So it could obviously help them in the short term. But if you want to interact with the global financial system, you need to be in SWIFT. So that's why it was assumed to be a huge deal for them. At the same time, Russia's disconnection from SWIFT could trigger huge movements in FX markets. It is estimated that Russia could have up to 300 billion of hidden exposure on the dollar through swaps. The disconnection from SWIFT could therefore trigger a strengthening of the dollar. We've also seen bonds of the Russian government fall dramatically. So basically, if you own Russian debt, then at this point, it's almost worth not as much. Well, it's really not worth as much. It's almost worth nothing at this point because they're based on the expectation that Russia will repay. So if their central bank doesn't even have the money because of their currency reserves to pay back whatever they're doing at the moment, that sets expectations down the line. So we've seen a huge disruption in that for banks or investors that had exposure to Russian debt. You can see here Russia's dollar reserves likely shifted to swaps after it dumped treasuries. Now, one of the main markets being impacted is commodities. Commodities, as we've mentioned in the past for Russia, huge exporter of commodities. You would assume you've been hearing that in the news if you've been following. Main ones are oil and gas. But as I talked about in a previous video, again, which you can check out on the YouTube channel, but I'll mention it here again, palladium, platinum, and wheat. Wheat is a huge export of Russia and Ukraine. About 30-40% of global wheat is exported from Russia and Ukraine. Palladium and platinum, key metals, yes, precious for a sort of store of value, but actually used in manufacturing and in industry, and probably going to be increasing in use in the coming years through batteries, renewable energies, and so on. And oil and gas are the most obvious ones where they have a huge reserve of oil and gas, although it's about 5 million barrels per day. So it's not something, when you account for the total demand or supply of the world, which is about 100 million barrels per day, it's significant because it's about 5%, but it's not impossible to counter or find other sources. Yes, they might be more expensive, but it's not as a crisis as you would assume in the long run. Now, that is impacting, as I mentioned at the beginning, all the prices of everything else because commodities then go in, especially energy commodities, go and reflect on everything else. Once again, if you have any questions, if anything is unclear, feel free to ask in the chat. We're going to do a Q&A section towards the end, but if you have anything that so far has been unclear, feel free to ask, and I'll try to get to that as soon as possible. Also, if you've enjoyed this video so far, feel free to leave a like, subscribe to the channel for additional content. Europe should manage with oil. So as I said, there are alternatives for Europe. The Netherlands, Germany, and Poland buy the most Russian oil and fuel in Europe. See here are some of the pipelines. S&P Platts estimated that about 2.2 million barrels per day of oil is flowing to countries supporting Ukraine. These are levels that are theoretically replaceable by the US or OPEC countries. Oil does not. So when you see there's OPEC and OPEC plus, plus is Russia. Oil does not require as complex an infrastructure as liquid natural gas. JP Morgan predicted levels of about $120 in the event of Russian invasion of Ukraine. Prices have reached 106. We've actually seen it even more than that, about 110, 14 even. So far, oil exports have not been shut down, as would happen if, for example, Russia were cut off from SWIFT because they couldn't receive payments for that. So you can see here a lot of pipelines going through Europe, through Eastern Europe into Europe. Now, these are the countries that are going to be affected the most. Germany, which really was even in favor of Nord Stream 2, which was a pipeline that was supposed to go from Russia into Europe. But at the moment, the huge shift in sentiment throughout markets. Everybody's okay with now just sanctioning that. They're saying that basically that was one of the main cards that Russia was going to play, was the over-reliance of Europe on their natural resources. And now we're seeing European countries just shift, being, okay, we're going to look for alternatives, both in a sense of in the immediate term with other sources of oil and gas, and also in the long run, rushing to nuclear, rushing to hydrogen, wind, alternative energy sources as well. Liquid natural gas, which is LNG, is not a solution in the short term. Europe has around 30 LNG regasification sites, so that when they're turned back into gas, 2/3 of the world's LNG is sold under long-term contracts. The main customers are South Korea, Japan, and China. So you have to have a long-term contract in the sense that you sign a contract for years to come. They have expressed interest to redirect their supplies to Europe in case of suspension of gas exports by Russia to Europe. We've seen some sanctions as well from not just European countries. Obviously, we've seen sanctions from the US, Canada, even Japan, South Korea. Even those countries are now sanctioning Russia. Even Turkey. The Economist points out that 10-15% of Russia's gas supply can be covered by liquid natural gas quickly. In December, half of US LNG was going to Europe. If the other half was added, this would cover 20% of Russian supplies to Europe. The world's biggest LNG exporters are Australia, Qatar, and the US. Russia sends around 23.3 billion cubic feet of gas to Europe daily. The entire global LNG market is valued at about 53 billion cubic feet. Global gas consumption is about 400 billion cubic feet per day, showing that LNG is still a small fraction of the total market. Nat gas in the US, the whole market is about 90 billion cubic feet. The ability to export more and therefore influence the price is limited by the ability to liquefy gas. So there are practical constraints to how much we can replace the liquid natural gas from Russia. But if you look at it in a geopolitical sense, in a global sense, if you stack a little bit from here, a little bit from there, you can actually combine them all into enough to cover almost all of it. Prices in Europe are almost 10 times higher than the US. A year ago, prices were only 2 to 3 times higher, which, I mean, it's still 2 to 3 times higher, but now it's about 10 times higher. So we are seeing that huge increase, which, again, we keep receiving news, especially if you live in the UK, higher energy bills, higher costs for the average consumer. And I'm sure that is the case for all of Europe as well. Tight situation on aluminium. Aluminium, another key export or another key raw material as well. Russia accounts for about 10% of global aluminium exports. Hugely important industrial metal. Rusal, the largest producer, has already experienced sanctions from the US, which is about 6% of global production. Now it's quoted at about $3,500 per ton. Global inventories are at their lowest since 2007. We can see that here has helped the prices gain significantly. Tight energy situation in Europe does not allow to produce at a profit. Energy alone to produce 1 ton of aluminium costs more than aluminium itself on the market. Data from France, but the situation is similar for the rest of Europe. So we are reaching that. We talked about this actually about a year and a half ago, almost 2 years ago at this point, at the beginning of the pandemic, where if you remember, if you were following the markets at the time, oil went negative. So especially WTI went into the negative prices. And then by the time it got actually up to about $40 to $50. So we talked about that in a video we did, well, I did, on the prices of commodities and the production price of commodities and how different oil producers, for example, Saudi Arabia, the US, Russia, they all have different costs of production because of whatever factors that may affect the fracking, the plants themselves that are refining. And so if the price of production is higher than the price of sale because of the market, then it's not longer convenient to actually produce that. What you can do is raise the prices, but if nobody's buying, then that's the problem. So, for example, a small example would be that, for example, WTI, oil WTI is about $45 to $50 to produce in the US, while Saudi Arabian oil costs about 10 to 12, maybe $15 to produce. So as soon as it hits $15, they're already breaking even. Now you can imagine with $120 barrel now how much profit they're making. Obviously, for US, if it costs $50, if you're selling it at 30, which was the case for a little while, then they're losing. And in fact, we saw a huge shutdown in shale production because they were just no longer competitive. These are people at the end of the day that have to run a business. So a similar situation here we're seeing with aluminium. Turmoil in the grain trade. So Turkey and Egypt are huge importers of Russian grain. Russia and wheat. Russia uses 3 ports in the Black Sea, not the Azov Sea, where Russian commercial vessels were allegedly attacked. Russia does not use Ukraine's water territory to export its products. Ukraine has lower wheat exports, but significant corn exports destined for China and the EU. Ukraine has stopped shipments from its ports. Egypt reports cancellation of purchases from both Ukraine and Russia. If Turkey decided to block Russia as well as Ukrainian ships, 30% of annual wheat exports and 20% of corn exports could be threatened. However, Turkey is a large buyer of agricultural products from the Black Sea region, so such a scenario is unlikely. They are hugely reliant on that. And we can see here, wheat's exports destinations, Turkey, Azerbaijan, and Kazakhstan are some of the main ones. And then here we see Egypt, Nigeria, and several basically group of countries as well. So oil supply concerns continue to rise. We've seen a huge increase in the price of Brent, jumping above about $100 per barrel, 115 at the moment, 110, 115. WTI is about $1.50 off of that. So we saw in the recovery a huge disparity actually between the two. There was like over $10, $20 difference. Now that difference has become about $1, $1.50. Strong sanctions targeting Russia raise concerns about the hindered exports of gas from Russia or the cessation of oil and gas transfer to countries supporting Ukraine. As a retaliation, Russia is the largest exporter of crude oil to the European countries, nearly 3 million barrels per day. The United States is considering the release of strategic reserves, up to 60 million barrels, which would lead to price stabilization, at least in the short term. The EU, Japan are considering coordinated actions, so there could be, again, some coordinated actions to then counter all that potential counter sanctions from the Russians. Oil tanker data shows that China bought more crude oil from Iran than last month than it did at its peak in 2017, despite ongoing U.S. sanctions. So U.S. sanctions on Iran have been ongoing, tied to the Iran nuclear deal. There was actually some news just today that that deal might be reached in the very short term. So that would bring back on average, about 1.5 million barrels per day into the market. So as I said at the beginning, Russia accounts for about 5 million barrels per day. So if you imagine Iran just by itself bringing back about 1.5 million, and then you have other countries as well contributing to that, it's not impossible to recover from the shortage in demand or in supply, sorry. The United States, but there are still countries that, despite obviously the US sanctions, still do business with them, mainly China. The United States can fight high oil prices, also hitting Russia's main source of income through a nuclear deal with Iran, launching the Keystone XL pipeline with Canada. So that was something that was in debate. Environmental concerns aside, because those are being put aside at this point, which would force as well, enforcing OPEC to increase oil production faster. These are some of the factors that could impact oil as well. OPEC's spare capacity is still significant, although this does not mean that the group is able to increase production of 5 million barrels per day or more oil in the short term. So that would be to compensate for the Russian exports dropping. Further, we saw some companies looking for alternatives. Here is a graph from yesterday of the price of oil. Again, reaching a high of about 114-ish. BP and Shell sell their Russian assets. Those, honestly, most people did not expect this to happen in such a fast manner. But we saw that as well moving into the beginning of the sanctions. Total does not intend to invest anymore in Russia. In the oil and gas sector, Exxon has not yet announced what it intends to do with its projects in Russia. Likely will follow. The lack of Western giants investing in the oil and gas sector in Russia may cause increased problems with the sale of oil from this country because of their exposure. Total and Shell were responsible for introducing the LNG technology in Russia, the liquid natural gas. Without the participation of these companies, the developments of this technology and exports could be jeopardized. The technical committee of OPEC Plus revises its forecast for the oil market oversupply in 2022 to 1.1 million barrels per day, which is about 200,000 less. This has the potential to restore production faster. However, it is worth remembering that some countries have big problems with restoring production. Russia may now have even greater problems. JTC indicates that the OECD end of year stocks will be about 62 million barrels below the 2015-2019 average, while previous forecast was 20 million above this average. You can see here Brent price reaching a high of about 113 or 114, $114 Wednesday before pulling back slightly. Again, if anything is unclear, feel free to ask a question. We're going to do a Q&A section in a minute here. I just have a couple more slides to go, and then we're going to just do a bit of a question and answer section, whether it's about anything we talked about today or any market that might interest you. I'll try to get to that as soon as I can. Russia may use, so let's talk about gold. Gold, which was a huge asset for Russia. I talked about this in the other video, which you can check out on the channel. Russia may use its gold reserves to stabilize the situation on domestic markets after around half of its reserves were frozen. Russia is a significant producer of gold, around 10% of global production, but sanctions and swift cutoff may make it difficult to sell or buy gold. Russia announced that it is resuming purchases of gold in the domestic market. Such purchases were halted for around 2 years. They hold around 2/3 of global gold reserves in Moscow. Around 2/3 of its gold reserves in Moscow and the remainder in other Russian cities. Gold accounts for around 1 out of 5 of Russian reserves. Russian gold holdings are worth around $130 billion, and gold can be used to ensure continuity of foreign trade amid sanctions because it is always an asset that is in demand, and its price is relatively stable besides the past few days where we've seen huge fluctuations. Goldman Sachs says that the price of gold is almost likely to reach $2,000 per ounce. Bank's midterm forecast about $2,150. And here you can see who holds Russia's central bank reserves, largest holders of Russian central bank foreign currency and gold reserves by location. Gold is about Russia, obviously 21.7%, China, France, Japan, Germany, US, international institution, and UK. And Russia can still use its gold reserve to ensure continuity of foreign trade despite the currency depreciating to record levels. Finally, let's talk about sugar. Sugar with the lowest speculative positioning since 2020. That means the position of long to short positions. Higher oil price should encourage increase in production of ethanol in Brazil, especially when pressure to increase Brazilian exports mounts. On the other hand, plans to scrap fuel tax may lower probability or profitability of ethanol production. So what we're seeing here is as I said, a shift away from the environmental issue for a minute here. Because it was such a huge focus. In Europe, you have emission contracts. We did a good article on that on the news section. You can check out the importance of that and how that is probably going to be something that's going to be affected greatly because they are a huge additional cost on top of the actual cost of producing these and importing raw materials such as oil and gas. So that's the easiest thing that they can do to drop the prices is really affect something that they have an impact on. So they have control over the prices of emission contracts. They can drop them, which would lower the costs of these imports and raw material uses by European countries, which would help, obviously, in the short term, stabilize the market and account for any disparity. Not necessarily all of it, but it would definitely help in that sense. Similar situation here, we saw a fuel tax in Brazil. So a lot of countries have fuel taxes. They have additional costs that are tacked on the production costs and import costs. These are the first things that can be adjusted in the short term to provide some stability to the market. So keep an eye out for any news regarding any sort of taxes on oil and gas, because those are the things that really are most under their control and much faster that you can adjust than obviously getting more supply from other countries. Seasonal patterns hit that the turn off of the first and second quarter of the year has been negative for sugar prices, and pressure on price to increase may arrive in April and May, as this time when majority of cargo is shipped. Seasonal patterns also favor price gains during this time of the year. As always, this is past performance, does not necessarily reliable indicator of future performance, but it's important to keep an eye out for history because it doesn't obviously repeat itself, but it does rhyme sometimes. So sugar, you can see here on the daily chart, is breaking below a key support level around 18. Obviously this trend line here, which was tested several times, and you can see here the seasonal trend and the commitment of traders here, the indicator on the bottom as well. So finally, we're going to talk about wheat. Wheat, which I touched on earlier a little bit. Russia and Ukraine account for 30% of global wheat exports. Two countries export wheat mostly to countries in Asia and northern part of Africa, Egypt, and so on. Around 6 million hectares of wheat are planted in Ukraine, where the war rages on. The ANZ expects the biggest price gain to occur in 4 months, when majority of Russian and Ukrainian grain is harvested. ANZ points that the price could jump 50% from current levels for Australian wheat, but impact on prices will be visible in Europe and the United States as well. Russia banned its own wheat exports in 2012 amid a drought. Move led to a 60% gain over the next 2 months. If exports from Russia and Ukraine are in danger because of shipping companies refraining from sailing to ports in a war zone, some of them just can't anymore. Prices increased by a dozen or so percentage points cannot be ruled out. Again, these are not predictions necessarily, but they're possibilities. Wheat prices testing 1,000 cents per bushel. Nevertheless, at this point, it is unknown how much Ukraine and Russian wheat will be shipped to buyers. On the other hand, countries that were buying wheat from Russia and Ukraine began to look for supply elsewhere. So in the short term, the impact, as I mentioned for everything else that we've talked about, in the short term, the impact can be very severe. But the more contingency plans they have, the more they are accounting for potential other supply sources, the more it is possible to then kind of weather out the storm, and come out the other side. So that's that for the slides. Thank you very much for watching this far. Hopefully everything was clear. Hopefully everything was useful. In a sense, I tried to point out how things impact each other, what the main situation is on the markets. Let's move on to a question and answer section. So if you have any questions, feel free to ask. That's why I'm looking at the right here. I have access to the chat, which should be able to hopefully answer any of your questions, whether anything is unclear. If you enjoyed the video, if you enjoyed today's webinar, feel free to leave a like, subscribe to the channel, and yeah, let's move on to some questions. I don't know if anything it was unclear today. As I said, feel free to ask, or if anything really any markets that you're interested in that I didn't talk about today, because obviously it's very hard to cover every single market. But these are some of the main ones that are going to be impacted or are being impacted by the ongoing tensions in Russia. So I'm going to wait maybe a couple minutes for some questions, and then we can move on to that. So I saw a question actually earlier, Nadir asking which cryptos we can buy. Well, I mean, that's investment advice, which we don't give here, but we've seen a surge in crypto prices over the last few days. Slight return to a correlation of its safe haven status, particularly Bitcoin and Ethereum. But again, we also saw a huge increase in correlation potentially with the regular stocks because of an increase in investment. She wrote something about that in Bloomberg yesterday or the day before. So that was something that was a theme that was happening this week as well. So Chesney asks, how much does Russia hold gas of the world market? We saw that they have 5% of the oil and 30% of wheat, but I'm not sure we saw how much gas. Sorry if I'm not too clear. English isn't my first language. No, that was very clear. Thank you for your question. Don't worry, actually, very good question. So we can go back to actually this here. So you can see here, there's about 2.2 million barrels per day of oil flowing to countries supporting Ukraine. This is from Russia. And we can see here, 2/3 of the world LNG is sold on a long-term contract. The 10 to 15 can be covered by LNG. So about, let's say 20%, 20%-ish would be to Russia. Now, from Russia, sorry. I can't exactly find a figure of how much, but we can see here the biggest exporters are Australia, Qatar, and the US. Russia sends around 23.3 billion cubic feet of gas to Europe daily. So this would be about half of the entire global, or, you know, if about half, a little bit less than half, maybe 30, 40%, 35%, all based on these figures that we see here on source from Bloomberg. So I would confirm, but these are the figures that we have at the moment. So significant. Definitely a large part of Russian gas goes to Europe, but at the same time, there are alternatives across the markets. So not all of it goes to Europe. So obviously 20% of Russian supplies go to Europe, 80% don't. So if that 20% is 20% of 23 billion, you can do a slight math on that, about 4 billion, which can be accounted for, as you can see, some of the biggest exporters as well. Hopefully that answers your question. Trying to keep it a little bit more concise. Anybody have any other questions regarding anything we talked about today or any other markets that might be interesting to you? Feel free to ask below. Here you can also see the the gold charts as well. So let's recap what we talked about today. We talked about the economic situation, how much imports and exports Russia provides and Ukraine provide to Western countries and Eastern countries as well. As you can see, China is a huge part of this. We talked about the rising prices and how they're going to affect the rising price of commodities and how they're affecting every aspect of the economy, how the logistics in Europe are suffering, how stock markets have seen a significant correction but don't seem to be in a bear market for the time being. We also talked about how Wall Street is still overvalued, but the Russian stocks are tanking, not necessarily because of their performance, although the sanctions are basically shutting down their performance. We also talked about the sentiment and how that's changing. Moderate slide in the US. The Fed, so again, remaining a key topic, are central banks. Despite that, it's not expected that the Fed will change its approach based on what's happening, but the European Central Bank actually might. SWIFT sanctions, how those may impact markets, and then currencies and what's happening on that end. What happened to the DAX today, asks Sofian. So we saw actually a significant correction. Let me take a look at the chart as we speak. Actually, I have to pull it up on the other screen here. And I can give you like a real-time, let's see. So the DAX dropping further. So yeah, basically we're seeing, as I said, a change in sentiment on both the DAX and other stock markets globally. Hold on, sorry. So yeah, so we saw basically this change in the sentiment going lower. So the DAX hugely exposed, European market hugely exposed to Russian assets. It's going to be fluctuating. There's going to be volatility in the markets. I mentioned this in several videos we did in the past couple days or weeks. Very susceptible to news, very susceptible to any sort of change in sentiment. So we saw a correction, as we see. I'm going to take a look one more time here. Actually, let me pull up the X station here. Or we can take a look on the chart here. Hopefully you can see the chart. So this is the hourly chart of the DAX. Now, thank you for your question, Chesney, or Cesny. Sorry if I'm saying your name wrong. Okay, so you can see here, I like to draw lines horizontally, and I mean, I drew this probably a couple of days ago. You can see previous support does tend to become an important area in the next short term, at least, generally speaking. So you can see moving downward, this is a huge correction. Let's take a look on the daily chart. You can see here significant correction in the last, say, 2 months, about 15% correction, dropping down to this area here. So if I draw, sorry for all the lines, we'll take some of them away. This is because if you zoom in and you put the lines and then prices shift. So let's draw a rectangle here. You can see before we even, I drew these at the time, and you can see down the line, months later, these areas tend to become another area of importance. So which is why they're called reaction areas. So potential double top here, pull back past the neckline around 15,000 points, a psychological level. And then the past few days, obviously through the conflict, huge downward move, up and down on the dailies, but definitely about an 8-9% drop from below this neckline here. And we can see about 13,700 points, which in the past acted as a reaction area. These are really basically tied into what news is happening and all the, we saw actually today and yesterday, some German manufacturers such as BMW and Volkswagen really affected by the conflict as well, because they're going to stop production in some of their factories and production facilities as a result of the conflict, because they can't get their the components. So a lot of German companies being affected, a lot of European companies. But if I do, for example, this is the S&P on the monthly, let's go on the daily. As you can see, slightly better performance because obviously they're not as affected, but definitely some volatility, almost entirely equal candles for the past few days. And at the moment, you can see very tight with wicks up and down. Sufyan said it's like the COVID in 2020. Well, I mean, in a sense, it kind of is, because we're seeing huge moves. So let's go and take a look back and see what happened in COVID. So this is the weekly chart. COVID is this. This is COVID. So this is the COVID correction, about 35%. You can see this is the long-term average, 200. Now we're still above it significantly. We dropped below it during COVID. So as you can see, we're very, very far above this. Yes, we dropped below the purple and yellow line. This is US 500. Actually, let's take a look at the DAX as well with COVID. So actually, take a look at that. So what did I mention? V-shaped recovery on US indices. So V, as in it looks like a V. Straight down, straight back up. Sentiment is RSI is about 36, so leaning towards the oversold, but not quite. Let's take a look at the DAX on the weekly chart. Let me remove some more of these. Let's go on the weekly. So this is COVID. So you can see not quite as directly up. You can see it's more shifting sideways and horizontal, or diagonally rather, than the V. Actually, we can overlay the charts. So on the X station, you have the chance and the opportunity to overlay charts. We can actually do that in real time. This was the all-time high at the time. This is an area, as you can see. It took us, let's see how long it took us to get from here to here. It took us about 11 months or almost a year. Let's put the US chart on top of it. You can see V-shaped recovery here, reaching it slightly but before that other area as well. And you can see here, especially, the disparity starts to increase, where one's heading down, the other one's still reaching new all-time highs, here consistently reaching new all-time highs, and then European indices falling back. And now, obviously, this is the week where past couple weeks, huge downward move, but still, take a look, still in this area, testing previous highs, and for the third time really at this point. So Cesny is right. There was a meeting, or there was supposed to be a meeting with the Russians today. It's uncertain how these meetings are going to turn out, because of the fact that the demands from the Russian side don't seem to be, I would say, reasonable for the Ukrainians at this point. They want demilitarization. They want assurances that they will not join NATO. That's kind of the issue here. They're just not meeting at the same point. So it's almost like the demands are never going to be met. Now, if they do meet the demands, which I believe is unlikely for the time being, then maybe we could see a huge rebound, but potentially that would also be hindered by any sort of, if let's say they reach an agreement and then the bomb drops anyway, then that's just going to undo what happened. But yes, in a sense, we are seeing a similar reaction to what happened during COVID. And at the moment, that's kind of the situation here as well. Not quite as big. Again, I mentioned the long-term average is still not even close to that, really. But about 15% during COVID, we saw, here it is. Well, this was at the time. Let's remove this. During COVID, from the high to the low is about 41%. But then, it's stabilized about 35%. So about half the correction of COVID. And we're still about at the highs reached after or before COVID. So from the pre-COVID high to the recovery was about a year. And then another about year to drop back down to the high. So third time we reached this high. And really this area is where we found ourselves for the past almost 5 years at this point. 2017, we're still here. So the market has moved upwards significantly in the last year and a half or so, but all it takes, as you can see, is a 15% correction, and we're back at the high that we were at in 2017. So for the fourth time, we're around this area. It seems to be important. I would keep an eye out for this area as a support potentially. But again, huge moves could then trigger a sort of even bigger reaction from the markets. You can see here, this is a 4-hour chart. I'm going to take off the US chart. And you can see this is the DAX. Significant reaction, but still, we're here. Hopefully that covers it. Hopefully that was clear. Yes, keep an eye out for geopolitical issues. That's really what's impacting the DAX the most, and indices in general. As I mentioned in the slides, through here, the exposure of of European markets is much greater to Russia than the US for a variety of reasons, most notably the border. But at the same time, even the US index could be affected moving forward. So hopefully that clears up. Let's take a couple more questions and then we're going to end this webinar. I don't want to keep you for too long. We've always been here for an hour. But yeah, let's take a couple more questions and then we're going to end this webinar for today. We're going to have more. Also, I would like to remind you on the 19th, we have a masterclass, XTB trading masterclass, which has, we have the opportunity to have some excellent speakers, including the founder of Wall Street Bets, which will be discussing some of his opinions with us. So I'm very excited about that. I hope to see you there. It's going to be on the 19th. I'm going to send some reminders if you're in the WhatsApp group. Feel free to follow that as well. Just talk to your account manager and they will be happy to add you into the WhatsApp group where I send out daily market updates, news, what's happening, some charts. Maybe if something is a big news, I'll send that as well. And then obviously some marketing in the sense of, if we have events coming up. So 19th of March, trading masterclass. It's going to be a Saturday. Let me double check. Yes, it's a Saturday, 19th of March, where we have some very important speakers, including the founder of Wall Street Bets. So, very, very popular, especially last year with the huge surge in stocks of GameStop, AMC. A lot of those were driven by that subreddit on and that community. So it's going to be very interesting to have a chat with him and some other excellent speakers as well, which will be discussing their opinions. So you can find that as well and sign up for that and be there with us on the 19th. I'll be sending, again, some reminders. There'll be more communication on that, but I'd like to remind you from now just so you can prepare. Thank you for your question, Sufyan. It's always a pleasure to have you here with us. I've recognized your name, obviously, so thank you for following us. Thank you, Nicola. My pleasure. Obviously, everybody else, if anybody else has any, maybe let's take one or two final questions. If not, we can just close this meeting, close this webinar, and we'll meet you at the next one. We're going to have some more, and we're going to have some more events as well, as I mentioned. If you enjoyed this video, feel free to leave a like, subscribe to not miss out on the next one. The masterclass is going to be a webinar. So yes, it's going to be a live event. So feel free to show your support. You can ask some questions as well. It's going to be quite in depth, but very accessible to anybody who's looking to increase their knowledge of trading and the markets, and with some of the key key people in the markets as well. And maybe if nobody else has any more questions, I can understand. We did cover a lot. I don't want to overwhelm you. Thank you very much for being here with us today. It's been a pleasure. Hopefully you have a great evening, great weekend. Keep an eye out tomorrow for the NFP. That's a key report. Might have a significant impact on the markets. So we had the ADP report yesterday. Keep an eye out for the NFP tomorrow. We'll obviously keep you up to date on the X station with the news. And for anything else, obviously contact your account manager. They'll be happy to help you. Thank you very much for watching. Have a good evening. Good luck with your trading, and I'll see you at the next one.